here's the impulse correction. Take it down here, impulse correction. So this is where I need to get ready to buy, is on that late correction. And one way to determine that is to use this low on the curve type of thing. All you do, and I use the Fibonacci tool for this. I don't use Fibonacci for Fibonacci. I don't do that. But I do use this to determine where I'm at on the curve. And all I do, I click on, where is it here? Right here. You guys can see on the screen. Oops, go back. That little icon right there, that's the Fib tool. So I click on the extreme high, the extreme low, and that tells me where on the curve I'm at. If it's above 50% on the curve, I'm not allowed to take that trade. Okay, I'm not allowed to take that trade. If it's 50% or less, I am allowed, preferably, that 30%. Okay, that's the real sweet spot right there. If you have a strong trend, you can take it between that 30 and 50. Think of that as a buy. If you're scoring, rating this, from 30 to 50 is buy, from 0 to 30 is strong buy. Okay, you're late in the correction. All right, so let me show you the next slide here. Here's the actual entry, 20 contracts. You can see right there that blue arrow that's showing where I bought on that red candle. So what this was doing is when price was pulling back, you'll see it better. This is a 60-minute chart right here. When price is pulling back, you'll see on a smaller time frame, that was my entry. Here's my stop right here. Here's target 1. Here's target 2. Target 1 is set at a 1-to-1 reward to risk ratio, and this is exactly how I trade every trade here. I buy. Once I buy, I set my stop, and whatever the distance is from my entry to my stop, I use that same distance from my entry to target 1. Okay, so there's target 1 right there. You can see they're the same amount. If I get stopped out, I'll lose 2,375. If it hits target 1, I'll get 2,375. Now, if this hits target 1, what's my worst case scenario? What's the worst case that'll happen? It's a break-even trade. That's all it is. It's a break-even trade. Okay, can you guys live with that? I think most people probably could. Okay. Now, this is an excellent style, especially when you're first starting out. 1-to-1 right there. What this does is it allows you to let profits run. That's your target 2. Okay, letting profits run all the way to that higher target up there. But when you hit that 1-to-1, worst case is break even, which preserves your capital. You have, if it does stop you out after it hits target 1, break even. If it stops you out, if you get a full stop, for example, once I bought it here, if that thing came down and stopped me out, that's still an allowable risk amount. Okay, it's still an allowable risk amount. All right, so here's the next slide. Now we're inches away from target 1. It actually came up and kind of teased me. It went all the way up. Just, you can see, 1 tick from my target, and then the thing goes down. Okay, goes right back down. Yeah, Eddie, basically what I'm doing here is price came into the demand zone from that 60-minute chart, and once I get that strong move up, that what I call price shock, all I'm doing here is I want to buy a pullback into the smaller time frame demand zone, which in this case you have a level on top of level. You got a drop-based rally and a rally-based rally. So that's what triggered that entry right there. It's just a smaller time frame demand zone within the 60-minute demand zone. So it's like a demand zone inside of a demand zone. That's really what that is there. Okay, so that's why I entered there. Now, the other thing, too, is look at the time down here. This is late at night. Okay, so every night I kind of go through the charts and I pick out the levels that I want to trade for the next day. Excuse me. And this just happened to be setting up at that time. And so I'm like, hey, it met the requirements. Checklist, everything checks off. Go ahead and take that trade. So I don't care if it's during our market hours, and early morning, or even at night right here. Either one works fine. Okay, so that was back on yesterday. And then today, you can see 5.2 right there, midnight. We open up right here early in the morning. It gets very close. So this was, I think, about 5:30, 5:45 in the morning. That's when I took my screenshot. And so right there, it did hit target 1. So once it pulled back, it kept going up higher. So right there, at that point, my worst case scenario is the break even. Okay, that's the worst case scenario. All right, so now price heads up a little bit higher. Again, this is the 60-minute chart. Now, do you see how this green candle closed above this pivot high right here? What that is, remember, go back to the last hour at the pros, that is a technical stop. And that's how I trade almost every trade that I do here. I sell half at target 1, and then I manage the trade on the back half of the contracts. So I got 10 contracts left on this. I use a technical stop to do that. Okay, so there's the higher high. Here is a higher low. So I move the stop up right underneath that pivot low. So go back, you can see here's the stop down at 1575. And I move the stop to 1578 half. And that's just below my entry price. Fast forward, now it's going up higher. It's getting closer to my second target up here. Yes, that's correct, David. I'm managing it from the 60-minute chart. How did you take some off the table at break even? All I did right here, you can see right there, that's my 1-to-1 reward to risk ratio. That's a break even trade if it stops me out. So where is it? Right there. There's my 1-to-1 reward to risk ratio. So if this thing drops all the way down, collapses, and stops me out, it's a break-even trade.
Got it.
Yes, I do. Auburn, I do include all these screenshots in my trade journal. I print these out, and I keep track of them. I have a folder that I use, and I just put them in the folder and categorize them by month. So every month I just I print all these trades out and put them in that folder. It's how I journal my trades. Right, so anyways, we're getting closer to target 2, and then we hit target 2. So it hit target 1, hit target 2, and went up a little bit higher after